Hi everyone, and thank you for joining us for our June trade floor update. My name's David Erdemez. I'm the head of our research, consultants and product team here at PIMCO in Sydney. And today I'm joined by Rob Mead, portfolio manager and co-head of APAC portfolio management for PIMCO. Thanks for joining us, Rob, for today's discussion.
Pleasure.
Today we're going to discuss two really key items that are occurring in markets at the moment. One is the outlook for interest rates and monetary policy, and also talk a little bit about what we're seeing from some of the RBA toolkit, and particularly around, what that means for bank funding, which is quite important for all of our people watching today. And so if we maybe start with that first item, there's been a little bit of noise recently in the media around perhaps the path for interest rates to move higher, and particularly from the RBNZ perspective. Could you maybe talk about that a little bit and put that into the context of the RBA and what it means for us here in Australia?
So the RBNZ, and I guess for all central banks, it's all relative. And so when the RBNZ included in some of their forecasts some indication that rates would be higher prematurely versus what they'd previously mentioned, markets reacted quickly. So New Zealand dollar rallied, bond rates sold off. Since then, there's been a little bit more sort of stepping away from those forecasts and saying that's not really a forecast for where policy rates will be, but nonetheless it shows that when it comes to central banks taking their foot off the accelerator, there's going to be a lot of noise.
Yep.
And so it's great for us as an active manager,
Yep,
because we get to work out what's noise and what's reality. Since the RBNZ, we had the RBA, and they were much more measured. So they were very clear, let's wait for July. They've already told us that they'll make some more announcements in July. And so more recently they've been very measured. I think they're staying to the course, but there's a lot of news to come.
So what's actually priced into markets? Is it a real sort of change in stance? I mean, are we becoming a bit more hawkish in terms of the outlook for interest rates here?
Well, I think the good news is, and clients are asking about this all the time, the good news is that markets are forward-looking, right? So the markets aren't waiting, and they're also putting some sort of risk premium around where the rhetoric's coming out from the central bank. So while the RBA keeps saying, and they've reiterated very recently, that they don't expect inflation to sustainably be in the range to allow them to move the policy rate until 2024 at the earliest,
Yep.
the market's already got a hike priced in late 2022.
Yep.
And by the end of 2024, the cash rate's almost 150 in terms of how the market's pricing. So there's a lot of risk premium already built in, and the markets are really looking forward as much as possible.
So let's turn our attention now to, another aspect of what we're seeing from the RBA, and that is they've got, four things in their toolkit at the moment that they're focusing on, which are a cash rate at 10 basis points. We have yield curve control, out to 3 years where they're keeping bond yields at 10 basis points. We have quantitative easing where they're buying state government and government bonds. But then that fourth piece is around the term funding facility and how banks are funding themselves. I think the key thing that we're interested in is that expires in June. So that's a $200 billion facility. Banks can borrow at 10 basis points out to 3 years. So with that rolling off at the end of June, what does that mean for how the banks are going to fund themselves? What does that mean for term deposits or mortgage rates? Just put some context around that.
Yeah, it's a great point, and it's probably, as you said, of all the various tools, and there's many, it's the first one that gets switched off.
Yep.
And there's every indication that it ends at the end of June. There's about 75 billion still left available. Now that we expect at least some of that will be tapped over the next few weeks. But the most important thing is that I don't think there's a complete repricing of markets. Maybe there's a fixed rate mortgages go up a little because they have been obviously very low. So as you take out some of that cheap bank funding, the ability for them to offer that on to the consumer, to the borrower, is more limited. The other thing is, though, we saw just last week that one of the majors was able to issue over $3.5 billion 5-year and 10-year securities at close to record low credit spreads. So we don't think any complete repricing of the market's coming. We look forward to some of that change, though, in the sense that less financing, less funding from the central bank means probably more RMBS.
Yep.
So that's a sector we actually strongly prefer versus unsecured bank funding. So again, looking into the second half of this year, we should see a little bit more balance in terms of the supply.
Thank you for that, Rob, and thank you all for watching. If you have any questions that come from today's discussion, please reach out to your PIMCO account manager. Thanks again for your time.